Hey everyone, and welcome. Today, we're going to dive into some really eye-opening research that basically flips the script on what you thought you knew about the Federal Reserve. It turns out, when the Fed makes a move, the real action isn't where most of us have been looking.
Okay, let's just jump right into it. We all see the headlines, right? The Fed is raising rates to fight inflation. And the story we're usually told is that this makes our credit cards and mortgages more expensive, so we all tighten our belts and spend less. But what if that's just a tiny piece of a much, much bigger story? What if the real heavy lifting is being done by a completely different force that's been quietly reshaping our economy?
So here's our game plan. First, we're going to tackle a puzzle that's had economists scratching their heads for years. Then we'll meet the three key players in this whole economic drama. After that, we'll uncover a really powerful feedback loop. It's like the secret engine of monetary policy. We'll then see why this engine has gotten so much more powerful recently. And finally, we'll get to the big one. What does all this mean for you?
All right, let's kick things off with the central mystery. For decades, the smartest minds in economics have been trying to figure out exactly how the Fed's decisions ripple through the economy. It's a bigger puzzle than you might think.
You know, the old story is pretty straightforward. The Fed raises rates, borrowing gets more expensive, and everybody, from families to businesses, cuts back on their spending. Simple. But this new research tells a completely different tale. It says the Fed's power really flows through a small, wealthy group of people, and it hits business investment way, way harder than our personal spending.
And this is where that puzzle really comes to life. Check this out. The data shows that when the Fed hikes rates by 1%, consumer spending on stuff like groceries and gas barely budges. It's a tiny drop. But industrial production, which is a great stand-in for business investment, it absolutely craters. It falls by 3 to 5 times as much. So what on earth is causing that massive drop in investment?
To solve this mystery, we have to stop thinking about the average person. The truth is, the economy is made up of at least 3 very different types of households, and each one plays by a different set of rules.
First up, you've got the hand-to-mouth household. These are folks who are basically living paycheck to paycheck. Any money that comes in goes right back out to cover bills and expenses. There's not much, if anything, left over.
So here's the key thing about this group. Changes in interest rates don't really affect them. They're not borrowing much or saving much, so it's just not a factor. But their income? Oh yeah, that is everything. If their paycheck gets smaller, their spending drops immediately. Okay, next up is the emergency saver. This is your classic, responsible household. They've got a buffer, a rainy day fund tucked away in a safe place, like a savings account for, emergencies.
Now this group behaves exactly like the old textbooks say they should. When interest rates go up, they see an opportunity to earn more on their savings, so they tend to save a bit more and spend a bit less. This is that traditional channel we always hear about.
And finally, we get to the group that is the absolute game changer in this whole new story, the stock investor. These are usually higher income households. They've got their emergency fund covered, but they're also actively investing money in the stock market.
And their behavior is completely different. A change in interest rates doesn't really make them buy less stuff. Their day-to-day spending is pretty stable. Instead, their reaction is to move their money around. They rebalance their portfolios, and any extra dollar they earn is probably going straight into the market. This, right here, is the key that unlocks the whole puzzle.
So the actions of these stock investors don't just happen in a vacuum. They kick off this incredibly powerful feedback loop that takes the Fed's initial move and just cranks the volume up to 11. Let's walk through how this works step by step. First, the Fed raises rates. Suddenly, safer things like bonds look a lot more attractive. So, the stock investors start selling stocks and moving their money into these safer assets. That means less money is flowing into companies through the stock market, so those companies cut back on their own investment. Well, less business investment means less economic activity, and that leads to lower income for everybody. And here's the kicker. When those same stock investors see their own incomes fall, what do? They invest even less in stocks, which just amplifies the whole cycle.
And what's amazing is that this model lets us actually measure this. That initial decision to just rebalance a portfolio, that's responsible for about 40% of the drop in money going to firms. But the feedback loop, that indirect effect from falling incomes, is even bigger. It accounts for the other 60%. It's a massive amplifier.
So, this powerful engine isn't exactly new. But what the research shows is that it's gotten way, way more powerful over the last few decades. A move by the Fed today has a much bigger impact than the same move would have had 40 years ago. So, what changed?
Well, it really comes down to 2 huge shifts in the American economy. From the 1980s to the 2000s, income inequality skyrocketed.
And at the same time, stock market participation just exploded, especially among the top earners.
And I mean, look at this jump. In 1989, only about a quarter of American households owned any stock at all. By 2001, that number had shot up to almost half. That dramatically expanded the pool of stock investors, which in turn made that feedback loop we just talked about so much more powerful. So the researchers put this to the test. They calibrated their model for the economy of the 1980s and then again for the 2000s, and the results were stark. With higher stock participation in the 2000s, the exact same Fed rate hike caused a significantly bigger drop in both investment and overall economic output. The Fed's main tool just got a lot sharper over time.
So look, this is way more than just an academic exercise. It has real, tangible consequences for all of us. Because if the Fed's main policy tool now works primarily through the investment decisions of the wealthy, that changes how we all experience the economy, especially when it comes to inequality.
I mean, this quote from the research paper says it all. It's incredibly direct. The stock investment channel, the very engine we've been talking about, is the main reason that when the Fed tightens its belt, economic inequality gets worse.
So here's how it plays out. When interest rates go up, the wealthy stock investors move their wealth from stocks into safer assets. And who are they often buying those safer assets from? They're buying them from middle-class emergency savers who might be feeling the pinch from the economic slowdown and need to sell assets to raise cash. It effectively becomes a wealth transfer that makes the gap between the top and the middle even wider. And this brings us to a really stunning conclusion. The researchers asked, what if we just turned off this investment channel in our model? Well, in that hypothetical world, a Fed rate hike actually reduces wealth inequality. It is literally the portfolio decisions of the wealthiest households that flips the outcome on its head.
So we're left with a really critical question. For policymakers and for all of us, our main tool for keeping the economy stable seems to work in a way that also widens the wealth gap. As our economy keeps changing, have we accidentally created a permanent trade-off between stability and fairness?